over time, your investments drift, and so does your risk. That's where portfolio rebalancing comes in. It's the overlooked strategy that ensures your assets match your goals, your age, and the market's ever changing mood. From target date funds to manual rebalancing techniques, we'll break down what it is, how it works, and whether it's right for you. Because sometimes protecting your future means shifting your portfolio before the market forces your hand.
This week, for our educational topic, the fifth thing, we're going to be talking about the importance of rebalancing portfolios. What is that? Should you do it? Gary, why don't we start with give us a high-level overview of what it means to rebalance a portfolio.
All right, Rob. Well, let's imagine that, you decide to start investing in your 20s. And, you go speak to a registered investment advisor or somebody, an investment professional, and they say, hey, listen, for somebody like you, we're really recommending that you be 100% in stocks, or maybe, 80% in stocks, 20% in bonds. And you say, okay, well, that sounds good. And, you put your assets in there, and then two things will happen, Rob. One is you're going to get older over time and take on responsibilities, potentially like getting married, like having kids, like having a home. And, those can be wonderful decisions. They can also be expensive decisions. And then, when you get much older, your investment time horizon decreases. You don't have as much time to make up for investment mistakes. And so a lot of times advisors would recommend going to the perceived safe haven of bonds, and having less equity exposure. Those assets tend to be more volatile. The second thing that will happen is the value of your investments will change around. Over the last however many years, we've seen a generally rising stock market, certainly not all the time, but the market's gone up a lot in the last couple of decades. And so you could have a situation where certain of your assets, certain of your stocks have done really well and become a bigger part of the portfolio. That's particularly the case for people like DKI subscribers who own huge amounts of Bitcoin and gold. Like we've had a phenomenal year. But for many of us, when, we started buying Bitcoin in the $15,000 to $20,000 range, now that it is roughly 4, 5, 6 times that level, depending on the day. A lot of the Bitcoin we bought, it's up 6x. It's become a huge part of the portfolio. And so there's a question: should you rebalance? Should you trim your larger positions and buy things that haven't done quite as well? And also, should you change your allocations as you get older and your investment time horizon shortens? And so that's what rebalancing is. It is saying, over time, I started like maybe 80-20, 80% equities, 20% debt. But, maybe over time, the equities have done well, the debt hasn't done well, and you might be more like 90-10 or 95-5. And then if you've added assets like alternatives like Bitcoin or gold, sometimes people added those as like 5% positions. Those might be 25-30% positions now. And instead of having a 5 or 10% allocation to alternatives, people are finding they have a 30 or 40% allocation to alternatives. So rebalancing, whether you want to do it or not, would involve selling off some of those assets, bringing them back down to the 5, 10, 20% range, and buying some other things that maybe haven't done as well.
Gary, just in terms of best practices, when should people rebalance? Should they do this regularly? What's kind of your recommendation in terms of how to look at the timeliness of rebalancing?
So it's a really good question, Rob. And a lot of it has to do with, if you're watching this, it has to do with your age, your personal circumstances, and your appetite for risk. Right? There's no free lunch on any of this. And so a lot of this really does depend on people's individual circumstances. Here's what I view as the plus and minuses of it. The positive of rebalancing is it forces investors to sell assets that have appreciated in relative value, and then they buy assets that have depreciated against the rest of the portfolio. And so to a certain extent, it forces people to sell the stuff that went up and buy the stuff that is more cheaply valued. And that seems to make sense. But it violates a key rule of that a lot of traders follow. And the reason they object to that is they prefer to let their winners run and cut losses quickly. And so, in those situations, they're saying, wait a minute, why would you cut your winners? Why are you buying your losers? Like, from a trading point of view, it doesn't really make sense to a lot of really good traders. In my opinion, I don't think there are best practices in this matter, and that your portfolio should reflect both your current risk tolerances as well as the opportunity set for your best investment ideas. So, as an example, rolling into 2020, my portfolio was 100% equities. And because of, the amount of stimulus that got thrown into the economy in 2020 and what the government did there and seeing inflation coming, I started to buy positions for the first time in gold, a small position in silver, and a large position in Bitcoin. And those have become massive parts of my portfolio. But one of the reasons they were able to do that is I let them run. The key thing here is, in my opinion, the opportunity set changed. In 2020, I wanted to be long. By the end of February of 2020, I had huge short positions against the market. And by the end of 2020, I had large positions in gold and Bitcoin and a small position in silver. And so for me, it wasn't that my risk tolerance changed or that my age changed that much. It really was more a matter of the opportunity set in the market change. And I think that's something that Deep Knowledge Investing has been able to do for our subscribers, where we've said, hey, listen, we've been investing in this way because these are the circumstances. And when the market changes, when the Federal Reserve changes, when inflation changes, when the macro environment changes, we've often said we're going to shift our investments. We're selling this, buying this. Now, our subscribers, they can agree, they can disagree, they can do what they want with it, but they at least get a very clear idea of the reasons and the timing of when I'm rebalancing my portfolio. In my case, I'm not doing it because of age or to take money off the table. I'm doing it because I see the opportunity set in the investment landscape changing.
Yeah, I think that's a great point, Gary. And I think huge value for me personally, DKI is, it's one thing to buy a stock at a certain date and time when you think things are good, but it's a dynamic market, right? Things change, new policies come into play. I think that's what DKI does really well, is keeping everybody in tune in what's happening, what does the market look like, regardless of the landscape. Here's how we're going to help you position to make money in that particular market. And a lot of times that is changes, quarter over quarter, or year over year. It's not just sitting and waiting and letting things happen. So it's that active investment, which has been great. Gary, I guess last question on this topic is, what would be an objection that someone might have or a trader might have to portfolio rebalancing?
There are a couple of them. One is the one that we cited earlier, which is, it means selling your winners and buying your losers, or buying things that haven't done as well. And a lot of traders don't like doing that. Another one would be, a lot of times rebalancing is done to maintain certain assets in your portfolio. But what if the landscape has changed? So again, the example that I gave before is, prior to 2020, I'd never owned gold. I'd never owned Bitcoin. And when the government throws massive amounts of stimulus into the economy, I was looking for inflation hedges. I was looking for things that would do well as the dollar declined in value. Now, had I said, okay, well, my ideal allocation is 5% Bitcoin and 5% gold, then and kept selling them every time they went up to 6 or 7 or 8%, I would have left an enormous amount of money on the table. That I see continued upside for these things, and gold has more than doubled since we bought it, and in my case, Bitcoin is up more than 6x since original purchase and since some supplementary purchases. And so, we would have left a huge amount of money on the table. Now, it's not necessarily a bad thing to rebalance in the case of a professional investor, where I'm spending all day, every day, looking at the market and tracking these things and thinking about different investment opportunities. That's not something that I want to be doing. I want to be able to figure out, what do I think is the upside from here. So, I think rebalancing keeps things easy. I think investing continuously is more difficult. But, if this is what you do every day, then it's not that big a deal.
And that concludes this week's version of the 5 things to know in investing, the tariffs giveth and taketh away issue. We'll be back same place, same time, maybe different place, different time.
Different place.
Yeah, but we'll definitely have a recording up and at it as we normally do on Mondays to get this published and posted. Thank you so much for joining us. Again, head over to our website, deepknowledgeinvesting.com for more info.